Welcome to Momentum Investing, property investing made easy. One of the world's top podcasts on property investing, bringing you the top experts in the field so you can learn firsthand what it takes to create passive income and take control over your financial future.
Welcome to the Momentum Investing Podcast. I'm your host, Daniel Wood, and I'm very excited to have you here. There is so much going on in the global economy right now with the pandemic, the risk for a crash in the markets, that I asked a very experienced fund manager to come on the show called Mebane Faber. Mebane has worked for years in analyzing markets from all over the world. And so I wanted to hear from him with their high-level analysis. What do they see is happening in the market? What is going on right now? And how do they find good investments? I was also really intrigued while talking to him to hear what is the difference between different types of funds? How do you create your own fund? And what are the challenges that the fund industry is now facing? There is so much going on in the banking industry, in regulations, in competition, that it is very different from just how it was 5-10 years ago to how it is today. He shared some very intelligent insights into how they analyze different markets, how they analyze different companies, and what is the difference between different types of funds. And if you want to go that route to start raising finance, what do you have to do to be unique and stand out in today's market? I think funds is a very exciting method of raising finance. I know a lot of people that have used it to raise finance for property deals. So speaking to Mebane, who's done so successfully in stocks and learning his input, I felt was very valuable, and I'm sure you will get a lot of value out of it as well. So if this is your first time here, I want to thank you for joining us here at the Momentum Investing Podcast, and I want to invite you to join our Facebook community. It is at International Property Investors. So if you go to Facebook and either go to our Facebook page, Momentum Property Education, you can find the link group there, or just search for International Property Investors. You should find our community. In that community, we have over 1,000 investors from all over the world sharing ideas, asking questions, bouncing off of opportunities from each other, as well as we do weekly Q&As. I share videos every single day with tips, tricks, and things you can use to grow your property portfolio. So I invite you to join International Property Investors. Super excited. Now, I hope you're ready for the episode. Make sure you're subscribed to the Momentum Investing Podcast so you get notifications every time a new episode comes out. We have them every week. They come out on Tuesdays. So I hope you are excited and look forward to this episode. So with no further ado, let's let Mebane Faber take the stage. Welcome to the Momentum Investing Podcast. I am super excited. I am here with Mebane Faber, who is going to share with us some very exciting things about what's going on in the marketplace. So Mebane, thank you so much for joining us. We're super excited to have you here.
Great to be here. Thanks for inviting me.
Yeah, thank you so much. I mean, you're running multiple funds currently, so you are definitely tied into the marketplace and what's going on. The world is kind of going crazy, and I wanted to kind of tap your brains a little bit, and our community wanted to hear a little bit of what you were thinking about what's going on and how should we be acting as a smart investor in this marketplace?
Wow, that's a great question. My thesis is the world is always going crazy. In public markets, if you look at the history of the past 120 years, my favorite investing book, Triumph of the Optimists, kind of details all the zigs and zags for stocks and bonds and real assets like real estate and commodities. And we've written a book on the topic called Global Asset Allocation that examines a lot of these by the way, it's free to download online. That looks at a lot of these strategies going back over time, and normal market returns are extreme, and normal geopolitical news flow is extreme. I mean, we think we're living in a unique time, like every human does, and is, to be honest. But look back at the history of the last 100, 200 years. My God, it's always going a little bit batty. So politicians are going to be politicians. Countries are going to behave like they do, all that good stuff. But I'm an optimist, and the relentless forward progress of humanity means that as an investor, you have to bet over time on that concept of innovation and progress. And so owning a portion of the human race, ingenuity, and particularly ownership through companies, but also ownership through any sort of business. We talk a lot about this on our blog. We did a post this year called the Get Rich Portfolio, then followed by the Stay Rich Portfolio, and how I invest my own money. And these concepts of being an owner, I think we said we had three, we did a tweet where we said it was 3 simple bullet points. And I may get it wrong, so apologies, but it was along the lines of you need to be the owner, meaning owning stocks or businesses, could be public or private. You could also be the bank. So instead of paying interest by having a lot of debt, ideally you'll be collecting it through some form of owning bonds and credit. And lastly is hold the keys. And hold the keys meaning this banner of real assets. And under that banner could be obviously real estate, could be residential, could be commercial, but also anything commodity related like farmland. Those 3 big asset classes and that allocation goes back 2,000 years. The Talmud, which is 2,000 years old, was talking about investing. They said, let each man put 1/3 in business, 1/3 in land, and 1/3 keep in reserve. And that allocation, by the way, 1/3 each in global stocks, bonds, real assets, is really nice allocation and also one of the hardest in the world to beat. It could be down the road from you guys at the Norway Pension Fund. It could be Harvard's endowment. It could be CalPERS or almost any professional investor. If you just index and buy that, it works over time. Now, back to your original question. I tend to be a little long-winded. I just had a lot of coffee. It's early here.
I'm the same way, so that's fine. Everyone in our community is used to me going off on a 20-minute tangent, so you're fine. You just did a 5 minutes, so you're good.
So the key takeaway is you want to have, in my opinion, a lot of that on autopilot and be an owner, and that just be the foundation. You want to go deviate from there and let the emotions of the world creep in. That's fine on the periphery, but as setting up a foundation and having that as a plan, I think is a great first step, because let's be honest, the world's always going crazy.
That's awesome. And I love the way you put it with you're actually owning a share of human ingenuity, that you're investing in humanity when you're investing in companies. So how do you go about choosing a quality investment? What are you looking for when you're choosing a company to own?
Yeah. So you hit on a good point, and everyone, I feel like, the challenge of being an entrepreneur and starting your own business, everyone gets that, but that's so hard. You talk to any entrepreneur and the agonies and ecstasies of businesses. There's like 2,000 businesses in the US that fail per week. And that's just normal. I mean, that's capitalism, that's free markets. It happens all around the world. Doesn't matter if it's a lemonade stand or a software company. But the reality is you can bet on the sum total of all those businesses, not just in one country, but around the world, and bet on the ability of capitalism and free markets to rise up people out of poverty, but also make everyone a lot richer. And we say that there's a lot of discourse right now and a lot of struggles about income and wealth equality. The good news is that anyone can become an owner starting with as little as $20. And so when you say, what are you looking at with companies? The first simple step is an innovation that existed 50 years ago, which is buying all of them. And if you buy the entire world of public assets, all the stocks and bonds in the world, you can get that portfolio for essentially free today in 2020, which is amazing. I mean, that's crazy. And the beauty of buying all of them is you can go talk to your friends at the cocktail party with a beer, with some wine, maybe some hot chocolate or coffee, whatever it is, your drink of choice, some tea. And you can brag. You can say, man, look, I own Tesla. I've owned Facebook for years. And the market cap weighting, the simplicity of it is if you own the index, as the stock gets bigger, you own more and more. As it gets smaller and goes out of business, you own less. That's a great first step. But if you were to go back, and the reason that can be delivered for zero cost, and you shouldn't be paying any more for that because it's a commodity, is it's somewhat a curious way to invest. However, no one invests that way in the rest of the world, where they say, I'm just going to buy everything with no regard to price. So my belief is, and this goes back 100 years, I don't take credit for it, of course, but under this concept and banner of value investing, which doesn't just mean buying the cheapest, but you also include the concept of growth, right? Two sides of the same coin. Buffett talks a lot about that. But at least having a fundamental anchor as to price of an asset. It could be your house down the street. It could be a fancy car. It could be a business. And the way to think about investing in stocks is to think about buying a business, not a stock. And so you have the very real situation of stocks that are expensive. It's a great company, but the stock's expensive. You could have a crappy company and the stock be really cheap. And I think making the distinction between the two of those is really hard for investors in general. But historically, and going back over 100 years, if you have a value mindset, it can outperform, and you tilt away from the traditional indexes. You can add 1% or 2% per year, which doesn't sound like that much, but it compounds over time and makes an enormous difference over years and periods of 10, 20 plus years. And so it also keeps you out of trouble. You know, we like to talk a lot about country stock markets. We wrote a book on this, also free. Largely, I have a TIFT with Amazon, so most of my books are free on our website. You know, we looked at valuations of entire markets. So the PE ratio, we call it the 10-year price earnings ratio, which Shiller popularized in the 90s. But you go back to really the time of Ben Graham. But it gives you at least something to work off. So you say, okay, on average, markets have traded around a PE of 17, 10-year adjusted for inflation. Now, of the 45 developed and emerging markets around the world, you have the scenario where they've been as low as 5. So I'll use the US as an example. It's been as low as 5 a few times, and it's been as high as 45 in the internet bubble. And not surprisingly, over time, if you pay a lot for an asset, your future returns, and I'm not talking days, weeks, quarters, months, even a year. This is over like 5, 10 years. If you pay a lot for an asset, the future returns tend to be low, and vice versa. If you pay 5 times P ratio, because remember with stocks and businesses, you're getting an infinite stream of cash flows, not just this year, but the next 5, 10, 30, 50 years. So anyway, historically, having a value mindset is important, not just because you're buying the cheap, but also you're avoiding the really expensive. Now, the good news around the world, and we track this for 45 different countries, most of the world is pretty reasonable. The US is one of the most expensive in the world at a value of around 32, or at least it was before this week. I have no idea what the market's doing today, but it was going down heavily yesterday. But most of the world is around 20, which is totally reasonable with low inflationary period. Plenty emerging markets, which are one of my favorites, are down in the low teens. And the cheapest of the cheap bucket is down around 10. So now you're getting a bunch of countries like Russia and Turkey and Colombia and Poland and Greece, which sounds scary, but historically that bucket has been a much better place to invest than in the really expensive stuff. You guys are normal. Sweden, I think, is around 20, so totally normal valuation. Neither bubble nor bust. But
that's Sweden for you.
The U.S.
Always a little boring, right?
But it's funny because it changes. You know, people always expect the cheap bucket. They're like, well, it's always going to be Russia. Well, no. I mean, the U.S. has been in that bucket before. The last 10 years is a great example. People would love to extrapolate their own very recent experience into the future forever. And the U.S. has dominated stock markets around the world for the last 10 years, but that's not normal. That's only happened where the U.S. has beat the world average a few times. It happens in the 2010s. It happened in the 90s, the booming internet time. Before that, it hadn't happened since the 20s. You're almost always better off diversifying all around the world. So sometimes the U.S. is cheap. So we go back to the 1980s. We did a call with some friends in Japan yesterday, and Japan was one of the most expensive markets in history in the 1980s. It hit a P ratio of almost 100. And at the time, it was the largest stock market in the world. So these countries have a way of changing places, but usually it's just, has a lot to do with sentiment, just how much people are willing to pay for something, the narrative, the story, the excitement. But they tend to change places over time.
Yeah, no, I agree. And for everyone who's not, familiar with some of that terminology, PE ratio is basically price per earning. It's basically how much, how many dollars you pay per dollar profit the company makes every year. So for some companies, you can get you pay $5, $10 for every dollar of profit they make. Others, you're up at 45, 100, which means, you're paying more money per dollar of profit, essentially.
And traditionally, something like a PE ratio, historically, if you're looking at just a stock or a business, it's hard to look at it in isolation, because you could have a PE ratio of 5 and say, oh man, this is super cheap, I'm excited to buy it. But if the earnings are declining, if it's not a good business, if they have some sort of like litigation risk or whatever, then it's actually probably expensive at a PE ratio of 5. And on the flip side, you have some stocks are trading at P ratios of 50, but because they're growing so fast, they can grow into it. So again, quoting Buffett, it's two sides of the same coin. However, typically when you get to the size of stock markets where there's thousands of stocks and global sectors, where you're talking about an entire sector, often it's a little easier to discuss something like the P ratio, which often mean reverts over time, just because you're lumping so many companies together over time, and these tend to, most of the time, not give you any information. Again, if it's trading from 15 to 25, not that big of an impact. It's only on the periphery when things get super crazy and weird that you kind of want to take notice. But going back to the very beginning, we were talking about news flow and everything, at least it gives you some perspective. Otherwise, you're just sort of blowing in the wind, shooting from the hip. This sort of like, I have no idea if things are, if the news flow is reasonable relative to these valuations.
So I would love to shift gear a little bit now. So one thing I'm really curious about, and I know a lot of people in the community are curious about, is and would like to be able to start their own fund one day. So I'd love to hear kind of, how did you get into actually creating the Cambria fund and start that journey? Because as you say, it's really hard being an entrepreneur. 2,000 fail every week in the US alone. And you've done something that so many people all over the world wish they could do. Could you give some wisdom to us there?
Yeah, my first piece of advice is don't do it. And then only—
That sounds like Richard Branson saying the best way to become a millionaire is to become a billionaire and then start an airline.
Yeah. Look, and I say that with a smile, but it's honestly pretty honest assessment. And the reason being is that unless you're completely consumed and obsessed with whatever the business may be, it could be making pizza, it could be again, a tech company, it could be asset management, it's really hard to run a business. And the first concept we describe to people is, they watch the show Billions or any of these things that glamorize, asset management and these rich hedge fund managers. As we say, the investing and managing money and the business of investing and managing money are two totally different things. You can have a love for markets and invest and do it with your own money. And guess what? You only have one person to answer to. If you're married, maybe it's your husband or wife or children or parents, but really you don't have, like we do, 50,000 people, over 50,000 people that, when you look like a fool, could or might be calling and emailing you and telling you how dumb you are. You don't have to deal with regulators and taxes. To us, it's the SEC, regulatory bodies. Spend all day with lawyers. It's just, you got to remember the non-sexy side of the investment business. So we always tell people, but this applies to anything, unless you're totally obsessed and love it, it's going to be hard because you're going to be competing against thousands of people that are totally obsessed and love it and are going to be spending nights and weekends trying to put you out of business. And on top of that, in the asset management industry, there are some tectonic forces shifting the landscape right now that are going to make this business look nothing like it has for the past 50, 100 years. It's been one of the best businesses on the planet. I think the asset management industry, out of the 150 odd industries, has, if not the highest, one of the highest profit margins. And quoting Jeff Bezos, he says, look, your profit margin is my opportunity. And so you have this shift where we mentioned earlier in the podcast, you can buy a basket of funds, and if they're indexed and you're doing nothing, which is what these index funds do that are market cap weighted, then there is zero cost. There's zero differentiation. And so that's great. As an investor, hallelujah, because cost is one of the biggest inputs that people should consider. They rarely do, but it has one of the biggest inputs on future wealth of an investment across the board.
Tony Robbins wrote a whole book just on that subject, Money Master the Game. It was, 24 hours on Audible just explaining, look at the cost.
And I'll give you a good example. In our global asset allocation book, we looked at all these strategies from all the gurus, and we include the Tony Robbins portfolio in that book. And we take them, these are people, the most famous investors in history, that have said, look, this is how you should do your allocation. You should put 20% in gold, 50% in stocks, 10% in real estate, yada, yada. Mm-hmm. Some people say, like Buffett, just put 90% in the S&P and the 10 keep in bonds, cash. Hugely different portfolios. And it turns out, if you go back all the way to 1972 and test how they've all done, the good news is they all do great. Again, going back to my earlier concept, as long as you own some of the ingredients, it doesn't really matter what the exact percentages are. The bigger problem is if you ignore entire categories. So if you ignore stocks, you don't have any stocks or any bonds or any real assets, it tends to be suboptimal because they tend to zig and zag over time. Look at this year as a good example. Gold and bonds having a great year in many places. Stocks had an absolute puke in Q1 and then have come back up, but having some things that sort of differentiate. But the massive, fascinating takeaway in the book was that the spread in any given year, these portfolios would differ in performance by like 30 percentage points, monster differences. But over time, they all coalesced into this like almost 1 percentage point band of performance, which is unbelievable. So the concept then of overlaying fees. So if you invested in the best performing portfolio, which was Muhammad El-Arian's endowment style, which had a lot in stocks, but just implemented it with the average mutual fund cost and the average financial advisor cost, it makes that portfolio far worse than the worst performing portfolio. Meaning what people spend all their time thinking about, the sexy stuff. What's the central banks doing? How much should I have in gold? Is real estate a good buy now? Is actually all meaningless relative to simply what you pay for it. And in 2020, you have the ability to pay very little, but people still don't. And eventually they'll die and get divorced and pass on the assets. And rarely do those go back to paying 1, 2, 3, 4, 5% fees. But that has been a sort of a, I wouldn't say a flood yet. It's been a trickle, but it's only moving one way. So anyway, advice of people going into the business, you need to take this into account. So if you're going into asset management, my belief is the world is going to barbell very quickly over the next 10 years into two types of firms. There's the firms like Vanguard, State Street, the biggies, the Schwabs of the world, who can deliver what we call these market cap weighted portfolios for essentially zero or close to zero, but they can do it because they have $1 trillion in assets. Yeah. Or if you're going to be concentrated and weird and different, you can charge more. Maybe that's 0.5%, maybe it's 1%. Maybe if you're the smartest person on the planet, it's still 2 and 20, like the traditional hedge funds. But you better damn well be really good or really different and concentrated. So much in the industry is what we call closet indexers. They say they're different and doing weird things. You look at their portfolio and put up, it just looks exactly like the S&P 500. Right. So you're paying higher fees for nothing. Right. So my advice, if you're going into asset management, this goes back to like the Charlie Munger, is go where the other people aren't fishing. If you're watching this on YouTube, you see this is a lake. You got to take a horse to get to this lake. It's a lot easier to fish there than it is in a town where there's hundreds of people fishing. So, hey, you want to be a really value-added investor who can charge more. Well, become an expert in small caps in Sweden, or maybe you go to West Africa and specialize in one sector. Whatever it may be, it's not going to be covering Apple. And so that's one piece of advice. And then second is that there's a million different parts of finance, right? So I think financial advisors will not be disrupted by the traditional automated software world anytime soon, as long as they're offering actual real value add, meaning are they doing all the other things, not traditional, just buy and hold asset management? Are they doing estate planning, taxes, wealth management, behavioral coaching, insurance, all that other stuff? And a lot of that will be augmented by technology, and hopefully all of it can be somewhat automated. But I think someone holding your hand and having the educational component is still worth the fees. But in 50 years, I don't know. So again, if you're going to go into our world, you got to love it, but also focus on something no one else is focusing on. I mean, how many hundreds of thousands of CFAs are there? Maybe thinking of new and different asset classes that no one else is really thinking about.
That's awesome. So what is it that makes you guys unique? What is your thing, so to speak?
We're totally willing to be extremely weird and different. And the reason that most people are not is twofold. Either they're an incumbent that has 100 billion or $1 trillion, in which case there's no benefit to being weird and different because there's massive amounts. You have this infinite cash flows, dividends that are streaming in. So being super weird and different is only potential downside and no upside. And there's a ton of career risk because we tell people this, and often, and we have 11 funds, almost $1 billion in assets, and people say, Meb, I'm going to buy one of your funds or invest in one of your strategies. How long should I give it? And we used to say 10 years, and people would laugh awkwardly. And now I actually say 20. And that's actually the reality of how the time frame you need for these assets and stocks and properties, whatever it may be, to work out. In the US, there's no greater belief universally held than stocks outperform bonds over time. I actually don't know a single person that does not believe that. And at one point this year, we had gone 40 years with stocks not outperforming bonds. That's a long time to wait. Yeah. And so God forbid you move to an active strategy or a value investor or small caps, whatever it may be. People traditionally don't give it long enough. So we're willing to be extremely concentrated. Most of our funds that are stock funds only hold 100 stocks. And that's out of an opportunity set of thousands, if not tens of thousands, securities around the world. So that's pretty concentrated. And then, some are universally, all of our funds are cheaper than the category average. So we're willing to do it for a low cost. And so the combination of those two, the number one thing that we do when we're launching a fund is we say, it has to either not exist or it has to be much cheaper or much better, and better is in quotes. Obviously we believe everything's better, but that could not be the case. And then it has to have some historical research. The longer, the better, either that academia or we've done in-house that's proprietary. And it has to be something I want to put my own money into. I don't know the case in Sweden, but in the US, most mutual fund managers don't have any money invested in their own fund, which is the most astonishing and horrific statistic, because if you're out here on CNBC and Bloomberg and Financial Times telling me I should buy your product, but you don't even believe in it or invest in it, you have no skin in the game, why in the world would anyone else invest in it? And so I put all my public assets into our funds and fully believe in them. But the real answer to your question is we're willing to move the needle, because if you're only a little bit different, it does nothing. You may as well just be in the index funds at no cost. So you have to be pretty concentrated and weird. And honestly, most just aren't willing to do that.
Sounds good. I love this because I love the way you're doing the long-term analysis and data. We have a lot of real and what do you say, analyticals in our community. So I'm sure a lot of them want to learn more from you and kind of reach out. You mentioned you have multiple books that we can get our hands on for free. Do you want to share a little how we can learn more from you before we wrap up this interview?
Yeah, absolutely. You can go to the blog, which is mebfaber.com. There's over 2,000 articles on there. You can download at least 3 or 4 of the books for free. My day job is CambriaFunds.com or Cambria Investments. We run 11 funds. And then you can watch me pick fights on Twitter at mebfaber, or, chat on the podcast too. I think we've done over 200 episodes. So plenty of content to keep you busy for a long, long time.
Sounds great. Thank you so much for joining us. I really, really appreciate it. And everyone who's listening, thank you so much for joining us. Stay tuned. I got some exciting news for you in a moment. Wow, I hope you found that as exhilarating and interesting as I did. As you notice in some of these interviews, I become like a little kid, learning and growing and just curious in that industry. I think funds is a very exciting way to raise finance, and the insights that Mebane shared, I think can be very valuable for all of us. I also liked the way he looks at the different markets and how he analyzes different opportunities. And it's something I have been using since this interview in my investing. And it's really brought a lot of value. So I really appreciated the interview. I hope you learned a lot as well. Before I continue, because I have a surprise for next week and I think you're gonna like it. Before I continue, I would want to ask you if you could review our podcast, because it really makes a difference for us in growing this podcast and reaching more people. Our goal with Momentum Property Education and the Momentum Investing Podcast is to help as many people as possible succeed as property investors. We do so by bringing some of the best people from all over the world to teach about success, about property, about specialties, about the broad. And our goal is really to give you that value. We really want to get the word out to as many people as possible. So I appreciate it every time you've told someone about the podcast and told them to listen. I hope you know my heart goes out to you and I really appreciate it. If you could give us a review, this is most commonly and easily done on Apple. So if you're using Apple Podcasts, if you have an iTunes account, please go to the podcast, scroll to the bottom and give us a 5-star rating. Maybe write a couple words about it. I would really appreciate it. So thank you. It's ironically not at the top you rate. You have to scroll to the bottom to do it, as I understand. So it's a little work and I really appreciate you putting that work in. So thank you. If you've already reviewed, thank you so much for it. Now, next week, you are in luck because I will not be your host next week. Instead, it's my co-founder of Momentum Property Education, Łukasz Brzezinski, who is the leader of next week's show. He's asked an amazing investor to come on the show and share a very interesting strategy that we believe is spoken about way too little. It is almost boring to some, which I do not understand because it is such a stable, quality strategy, which is what we're after, right? We want the stable cash flow. And there is really no better way of getting stable cash flow than through social housing. Łukasz and Carl Agar go through in detail how to get social housing contracts, how it works, the benefits, but also the risks, and how you make sure that you get that stable passive income coming in. So I hope you're looking forward for next week's show. I'm definitely looking forward to it myself. Make sure you subscribe so you get the update as soon as it comes out. I'll see you soon. Thank you so much for being a part of the community. I hope I see you soon.